The reason why broke people are broke is because they are their own income producing asset. And the reason why the wealthy people are wealthy is because they buy income producing assets. In this book right here by Daniel Priestley, The Key Person Influence, he teaches that income follows assets. So in today's video, how to use retirement funds for multifamily investing, I'm going to share with you how to leverage your retirement funds to build a passive stream of income. This video doesn't matter if you're a beginner, doesn't matter if you're seasoned. I'm going to share with you the pros and cons of using retirement funds. I know what you're thinking, so I'm going to share with you how to neutralize the penalties and taxes of using retirement funds. And then at the very end, I will give you an example, okay, to follow for direct implementation. I'm excited. You excited? Let's get started. I'd like to start off now with the pros and cons, and I will begin with the elephant in the room. And that is, what are the cons of using my retirement funds? What are the cons of cashing out? Okay, there's two huge ones I need to discuss with you. Number one is when you take money out of your retirement account, you're going to pay a 10% penalty. Okay, unless you are 59 and a half years old and greater, there's no penalty. All right, so 10%, that's a large number. Okay, next you're going to pay regular income taxes on any amount of money that you withdraw. That's huge. Okay, these two things can stop anyone from withdrawing money. All right. And thirdly, just the fact of withdrawing money, your hard-earned money all these years to put into real estate is frowned upon by tradition. Okay. Tradition says keep the money in there long term until you die. And that's tradition. Okay. Now, there's a disclaimer here. The disclaimer is from me to you is that do not, I repeat, do not withdraw any money from your retirement funds unless you have a plan, unless you have help from an advisor like our company. So I'll give this offer to you. If you just want a plan or a no obligation plan, just 1, 2, 3 options, go ahead and text Peter to 833-942-4516, and one of us will just give you some options of what to do with your retirement funds. Okay, no obligation. All right. Okay. Next, what I want to do is go over the pros of using retirement funds to buy multifamily. All right. The first pro is cash flow and regular income, which does not happen over here with your retirement funds. It only happens when you buy a property, when you buy an income producing asset. Number two, you get depreciation. Okay, depreciation is a huge tax write-off. Is one of the most amazing things for commercial real estate. And you can also do what we call a cost segregation study. Okay, what that is, and the video will appear on that, you can rapidly depreciate your property and establish huge tax write-offs to mitigate these two things. Okay, to totally mitigate these two things. I'll share with that in a minute. Okay, and then next you get appreciation. You get appreciation, property appreciation, two ways. Number one is over the months of paying down the mortgage, guess what happens? Your equity goes up. The property appreciates by basically your tenants paying your mortgage, okay? And next we have forced depreciation, which we love, which is basically you increasing your rents over time, 1 or 2 or 3 years, increasing your net operating income, making your property worth more, right? So that's appreciation. And then next you get insurance against total loss. If your property burns down, your multifamily, you have insurance and then you can rebuild your property. If your stocks, for example, if you invest in a company stock or something and the CEO or has a moral failure and it gets all over the news, the stocks may plunge down to nothing. You don't have insurance against that, okay? Multifamily, we do have that insurance against total loss. Next, you may be able to experience a tax-free liquidity event. What is that? Okay, well, if you have a home and you perform a cash out refinance, you pull from your equity in your home, guess what? That's tax-free. You don't pay taxes on that until you sell the property. Same thing with multifamily, but the numbers are huge. You can add a zero to that, okay? So you can basically increase your rents, increase your NOI, force your property value, okay? pull out that equity, put it in your pocket as cash, and pay no taxes on it. Okay, so tax-free liquidity event that you can't do with your retirement funds in a retirement account. Next is, this is huge, okay? This changed my life when I became a real estate professional. That means a real estate professional, per the IRS, means I own real estate and I work more in real estate, managing my properties, right? And more than I do on my job, okay? So buying multifamily gets you on the road to becoming a real estate professional. What that means is you get unlimited tax write-offs, everything. I can write off the camera that I'm looking at. I write off all this video equipment. I can write off all the lights. Everything in the studio is written off because of commercial real estate, okay? As a regular W-2 working person, you can't do that, okay? But when you work in real estate, everything that helps you with your business, you can write off everything, okay? All right, and then lastly, let me just say this. To get started experiencing all these pros I just mentioned, sometimes all it takes is just one deal, okay? One deal. All right, okay. Next, what I want to do with you is give you a real example that you can implement yourself right away. Let's do that next. Let's jump into two real life examples of how to implement your retirement funds directly into multifamily investing, okay? All right, so I'm going to give you two examples. One example will be using a conventional bank, and the second example, I'm going to share with you how to leverage your retirement funds using seller financing, using creative financing into a larger property, something that we are really good at here at Commercial Property Advisors. Okay, all right. So let's say your retirement account has $200,000 in it. Okay, if you look up on the internet, the average retirement account has about 94,000, and then but the median is over 300,000. So I'm right in the middle here. Okay, all right. Okay, now step one of two is to liquidate the 200,000. Take it all out. Okay, now you're going to pay a 10% penalty, as I said, of 20,000, unless you're 59 and a half years old and there's no penalty. Okay, and then we need to include paying regular income taxes. I'm using 15% tax bracket here. That's 30,000. Okay, so you took out 200,000. It's going to cost you a total of 50,000. So that means you have $150,000 less. Okay, again, is it worth doing? Okay, I will say yes, and I'll prove it to you. Okay, so step two is to buy a 5-unit apartment building for $500,000. And guess what? It's not going to be in California, may not where you are, but in the Midwest, you can find those properties. We do all the time, okay? That's $100,000 a door. It is possible. So hold your comments, okay? All right. Down payment will be 25% of the $500,000. That's $125,000. That's your down payment. Remember, you have 150, okay? Then we have closing costs of about $10,000. So your total out of pocket to buy this deal is $135,000, okay? This deal will cash flow about $800 a month, okay? Not too bad. I mean, it's not a great thing for a 5-unit, but it is what it is in today's market, right? And this equates to a cash on cash return of about 7.1%. or an ROI of 7.1%. So not super fantastic, right? But again, is it worth doing? Is it worth cashing in $200,000 to make $800 a month with a 7% return? And the answer is yes. And in a few minutes, I will prove it to you. Okay, so hold tight. Okay, this is using a conventional bank loan to buy multifamily. Now I'm going to show with you how to leverage the same liquidation here using creative financing. Commercial property advisors, we love to teach creative financing. In fact, we have a large chunk of our training that we put our students through to understand how creative financing works. Okay, so that's part of a basic training. All right, so here's what we're going to do. We're going to buy a 12-unit for $1 million. And some of you are thinking, where is that, Peter? Again, it's in the Midwest. In fact, I have a picture of it, of a recent closing of our students. So there you go. Okay, all right. And then, so what we're going to do is we're going to use a concept called the master lease agreement, something we're really, really good at, something I've been doing for like 20 years. Okay, some of the training will appear on the screen so you can learn how it works. But basically, that's where the seller becomes the bank for you. Okay, and you're going to put down a 10% down payment. You're going to pay an interest on that money that you owe him, and it'll be for a few years. Okay, that's just a quick summary of it. But when you do a master lease, it's no credit required. There's no bank involved. You don't need any experience. You just need a good plan and know how to convince the seller on how to do this. Okay, all right. So we're going to buy a 12 unit for $1 million. We're putting down 10%. 10% of $1 million is $100,000. And remember, we have the same $150,000. Okay, same 150. Okay, we have closing costs of $10,000. So our total out of pocket is $110,000. This is going to cash flow $19.20 a month on this 12 unit property. Again, not a whole lot, but it is a good sum. All right. And the reason why it's a little higher than using bank financing is because we're using seller financing where we get to control the interest rate. So we're not using today's interest rate on this deal. We're using something much lower because that's the beauty of seller financing. Okay, when you get a motivated seller together with a motivated buyer, that's you. Beautiful things can happen. Okay, all right, like a deal like this. Okay, so we established a cash flow. Now, again, you have $150,000 to use. Okay, and then you use 110, so there's $40,000 left over. Here's what you're going to do with the 40,000. You're going to use the remaining $40,000 to renovate all 12 units as best you can. You may not get through all 12, but this is going to take you 2 to 3 years. Okay, 2 to 3 years. So I'm talking commercial takes time. Okay, takes time. So over 2 to 3 years, what you're going to do is you're going to get the rents up $100. Who can't do that, right? So very modest increase. Okay, and you can probably do a little higher, but I'm keeping this very modest, very conservative. Now, I'm going to share with you the math of the beauty of just increasing the rents $100 over the course of 2 or 3 years. Let's do the math. Okay, so you have 12 units and you're going to raise the rents $100 a month. So $100 times 12, that's an additional $1,200 a month, right? Now, if I multiply that by 12 months, that comes out to be $14,400. This property is in a 6 cap rate area. So if I take this income and divide it by 6%, that equals $240,000. What that reflects is the forced depreciation. Okay, and it's only by $100 a unit. Almost anyone can get the rents up over 3 years, $100 per unit. Okay, with the renovation. Okay, so you have a forced appreciation of $240,000 plus now you're probably making more than the $19.20 a month. Okay, so the big question again is this worth using your retirement funds on? Okay, and the answer is yes. Now, what I'm going to do next here is I'm going to share with you the elephant in the room, and that is you have to pay these taxes and the penalties. How do we neutralize and mitigate all that to come out ahead? I'm going to give you a quick example next on how that works. All right, in this last part, I am going to answer the question for you, is it worth cashing in my retirement funds? In this case, $200,000. And the answer is yes, okay? And I'll share with you using this example, and I'll share with you how we're going to neutralize the 10% penalty and paying the income taxes. And so if you recall from this previous example, $200,000 retirement account balance, we're going to pay 10% penalty to use it, 15% of taxes. So I have a total of $150,000 of that. That means I only have $150,000 left over, right? So step 2 was to buy the 5-unit apartment building with a cash flow of $800 a month with a cash and cash return of 7%. Okay, all right. Now, here is step 3. Step 3 is to perform a cost segregation study. What that is a study. It's a study that you hire a cost segregation firm to do. It's a complicated accounting firm that will come in and do a study on your property in which the results can be that you can rapidly depreciate your property. So rather than depreciating it over 27 and a half years, you can depreciate it over 1, 5, 10, 15 years. You can do it rapidly. Okay. We just did this type of thing on a deal of this size in Illinois, and we got about $60,000 in tax deductions in year one. Year one tax deduction. Okay. Immediately bought it. Okay. And you got $60,000 of tax deduction. I'm going to use the $60,000 tax deduction. This is a bank of tax deduction against my $50,000 in penalties and taxes. Okay, so when I do that, I am coming out ahead $10,000. Okay, so $60,000 in tax deductions. I'm going to neutralize these two things. That equals $50,000. Okay, so I just showed you how to take care and neutralize your penalty and your taxes by doing a cost seg. So I have $10,000 left, right? Because I have $60,000 in savings. I use 50. I'm going to use remember, I have $800 a month in cash flow, 800 times 12 months, that's $9,600. I'm going to write off this $9,600 against my $10,000 left. So guess what? In year one, I have neutralized my 10% penalty, I have neutralized my income taxes, and I have neutralized my income taxes in year one. Okay? So is it worth cashing in your retirement account to do a deal like this? And the answer is yes. I just proven it to you. Okay. Now, thank you for hanging out this long. Let me answer this last question. What is the moral of this story? What is the moral of this video? The moral is to buy income producing assets. This is how the wealthy get wealthy and stay wealthy. Okay? All right. Thank you everyone for joining me. If you hung out with me this long, you are absolutely my favorite. Please do me a favor, go ahead and like this video. If you'd like to receive more videos like this, go ahead and hit the subscribe button. Hey, if you just want to read a book on commercial real estate investing, go ahead and there's a link that will appear. Just download it and get at it. If you'd like to be mentored by us and our entire team, including myself, and learn how we do all this with our students on the East Coast and West Coast, everywhere, a link will appear so you can apply. Thank you so much, everyone. I appreciate you so much. Have a great day, and I'll see you at the next video.